Hello and welcome to this very special conversation. This is in partnership with HDFC Life. Money Mile is bringing you a series of conversations around insurance. We're calling it Insurance Decoded. Joining me today are two very, very special guests. I have with me Prasun Gajri, who's a market guru. He's the Chief Investment Officer at HDFC Life. He's the man who manages all your money. So great to have you, Prasun.
Thanks.
Talking to you after a while. Deepak Yohannan, who has started his own entity almost a decade ago, which is into making insurance more accessible to you online. He is the CEO at myinsuranceclub.com. Thank you very much, Deepak, as well, for coming by. Well, we've been talking about insurance over the last few weeks, various aspects of it. But I think since you're here, there are a lot of people out there who would want to know what's happening with the markets. Mm-hmm. And you're the guy who goes and picks those stocks.
Right.
Are we in for some kind of a deep correction? There is a sense of nervousness which people have. How are you reading the entire market ecosystem, especially since there's so many global factors at play as well?
No, there is definitely a sense of nervousness which is building in, but I don't sense a deep correction, at least not from domestic factors. See, let's put things in perspective as of now. We have had 3 years when the macro was looking good, but the earnings were not really coming through. Now, for a change, while their macro isn't looking bad, there's a margin deterioration maybe in the fiscal deficit, interest rates seem to have bottomed out, but it's still pretty much within control. But at the same time, the earnings are coming back. This quarter, the earnings growth is clearly better than anticipated so far, and if this continues, I think that is very good news for the markets. The only issue with the market is that we don't know how the technical factors play out, how the flows play out, how the global plays play out, especially because we really don't know how the US markets end up behaving. So I think barring those factors on a domestic basis, I remain pretty positive because earning growth is back. And for markets, eventually all that matters is earnings growth. And this year, if that comes back, I think that will keep the market supported. Domestic flows have been good. While the long-term capital gain may be a slight dampener, but I don't see that as a big issue for the market. I think that will make sure that flows continue for the market. So put all that together, if I were to ignore this short-term volatility, I remain fairly positive on the markets. Yes, we will have election-related uncertainty at some point of time. We could have some global-related uncertainty. But if one is really looking at a long-term view, and which as an insurance company we tend to take, most of these factors, once they are behind us, frankly cease to matter. We have seen so many of these factors of the last 3-4 years also. We have seen Brexit, we have seen the US presidential elections, all of which was supposed to cause a lot of panic in the market. Now people will talk about Indian elections causing panic in the market. Frankly, if you look behind, none of those factors really mattered. So eventually what matters for the market are the earnings, and we have seen clear signs of an earning growth uptick. I think that is the biggest positive news the market has had for a while.
And the concerns around earning for the last many years now was when are they going to turn around? When
Absolutely.
are they going to turn around? And you're saying that turnaround is...
That turnaround is visible this quarter. I'm saying we expect that to continue. And if that continues for another 1 or 2 quarters, I think the market will take a huge... that will be a big year for the market in my view.
We'll come back to the investment piece. But Deepak, when any financial planner sits down with someone, while we as investors, our focus is on how do I invest? But I think the biggest issue, which many of them tell them to do straight away, is also to protect yourself. And I think many of us look at that last. How important in the financial planning piece is that you get your protection bit going upfront?
Well, I feel protection is probably the biggest factor which one should consider. While we would all want us to be aggressive investors and earn a lot of money in terms of getting returns, at some point become even very smart investors in the stock market. But the reality is that when you go to a professional, he will probably advise you a mix of different tools which one is conserve your capital. Second is, can you get a moderate amount of growth, not necessarily an absurd kind of a growth. Leave that to the people who are day-to-day toiling in the markets. So the concept of, I would say, insurance helps you in that. And now I think insurance is also gradually trying to eat into the mutual fund space also. So you have options wherein you can look at an aggressive portfolio, and products like term insurance, of course, which help you, provide a solid protection to your family. So I think it's an interesting time, aggressively priced products, both in the protection space and in the investment space. So I think the next decade is a very exciting time for the insurance industry.
Let's talk about investment a bit, Prasun. I think let's step back before we discuss products. Let's just step back. I find, and I don't know if that's the feedback that you get from especially young people today. They want to invest. I think the basic understanding that I can't just keep my money lying in a bank. I think we are going past that stage where people are now saying, look, I know that, and I think the falling interest rates kind of contributed to this thinking. I find people, even elderly people who are saying, why should I get 6%, 6.25% on my FD anymore? Where can I invest? But I think let's step back. Why is it so important to invest, according to you?
Very simply put, I think we have always been a country of savers. Let's put it that way. I mean, India has never had a situation where individuals have not saved. Individuals have saved. But I think there's a big distinction to be made between saving and investment. Saving is just kind of not spending a part of the money which you earn and just leaving it without any thought process as to what to do with that money. So therefore, it keeps lying either in the saving bank account or at best in a fixed deposit. Investing is adding some science to it. Basically saying, what are my objectives? What do I want to do with this money eventually? What do I want to do with this money in 2 years' time, 5 years' time, 20 years' time? And if that is what I want to do with this money, how do I use this money so that those goals can be achieved? That is what investing is. So effectively, investing is important. Number one, because you want to achieve certain goals. You have certain aspirations, and those aspirations can only be met if you save wisely and use those savings to put it in market instruments which can give you returns so that those aspirations can be met. Number two, I think it's a part of the discipline. Effectively, investing is basically saying, is thinking long term. Investing is not about maximizing your gains in 1 year or 6 months' time. Investing is allowing the money to multiply over a longer period of time. I think these are the two things why I believe investing is very, very important, and therefore some ground rules for investing in my view. One, start as early as possible, because the best thing for your money is long-term compounding. You can have good years, you make 20% return, 30% return in a year. You will also have years when you will make minus 20% return. But what matters is, what is the compounding you do over a long period of time? That is one. And the second rule of investing is, make sure you decide what is your risk appetite and what is your aspiration in terms of where you want to be in terms of your corpus. And based on that, the biggest decision you ever take is not choosing stock A over stock B, is to choose the right asset class. I mean, enough literature, enough science, enough research has proved that most of your returns emanate from asset allocation and not for security selection. So I think these are the two very important decisions, and these are the decisions which every individual should spend time on, take, and as Deepak said, along with this comes the aspect of risk management. Very clearly we talk about risk management in every facet of life, but people are looking at risk management, they are looking at, oh, maybe my market will fall by another 10%, I should get out of the market. But people are not looking at insurance part there. Clearly, because that's a far bigger risk you are running, and though the probability may be low at any point of time, the impact of that is far higher. And I think people tend to forget that when they're trying to plan their portfolio. So investing, long-term asset allocation with a protection base driven by insurance. I think that is the product.
If you actually insure yourself correctly, I think your appetite to take risks increase, and you can actually go slightly more aggressive. And if you stay invested in the longer term, then the chances of your returns are higher. It's without insurance, if you go whole hog into investment, is when the risk is substantially higher, and I don't think any reasonable person would advise you to do that.
In fact, I want to turn this around a bit. My view is that not investing is probably the biggest risk that you're making, right? Because you do have taxes. You talked about earlier that we've had another one tax put on us
Absolutely.
in this year's budget. You do have inflation.
Absolutely.
I did some calculation, and you would know better, but the last 20 years we've averaged 6.5%. But if you look at education inflation, you look at health inflation, it's probably much, much more than that.
Absolutely.
Right? So if you're just sitting idle with your money, you're actually running a far bigger risk.
Absolutely. Not doing anything is as big a risk as
because
trying to take action.
We say equities is risky, right? Or we say XYZ market linked instrument is risky. It's not guaranteed, right? We've had this obsession as Indians on guaranteed.
Yeah, absolutely.
But hang on, if you don't invest, it's a far bigger risk than what if you did rightly in any market linked instrument would be. Right?
So I have a slightly contrarian view here, and it could be, just to do with the fact that, historically we've been savers.
Right.
The real test comes when there is, and especially if you're participating purely in market linked, straight into equities. For a retail customer, the real test comes when there is a solid correction happening. Then what do you do? All your savings are in there, or a good chunk of your money is there. If you are a sensible person, will hold on. This phase will go. But I think majority of them panic. And I also have, my personal experience, I have sold off. So, the entire gains which you would have made if I had just been through that phase, I lost out. And that is something which is, I think, inevitable. Every retail investor will go through that because my money, hard-earned money is there. Let me protect whatever little is left of it. And, maybe at the start itself or when I see a 10-20% correction, I sort of, panic and move out. So that's, I think, something which is difficult to sort of, that's where probably mutual funds and investing the right amount, don't pull in so much of an amount of your savings that, you start getting jittery. So asset allocation there probably plays a larger role. Prasun.
So I can add to that in the sense that, see, each individual is different. Every individual has, so I would put it in two ways. One is every individual has a certain risk appetite. Now that appetite can be based on his age profile, his income profile, his general other investments. So that is, but then there's also a risk-taking ability. Right? Now that comes from your innate. Some people are high risk takers, some people will just palpitate moment the market falls by 2%. Now that is something which is very individual driven and cannot be changed. So effectively when you draw up your portfolio plan, you have to keep all these things in mind. And therefore take the right amount of risk which allows you to sleep peacefully at night. And at the same time kind of addresses the issues we talked about earlier. Clearly inflation is one of the issues which has to be addressed. If
but
it's not even
about managing your expectations.
And managing your expectations, because
we are a classic society where in everything else that we buy, we hunt for bargains.
Absolutely.
But when it comes to equity or any other market linked product, we intend or we want to buy when they're at their peak.
Yeah, so I think there is...
And we get nervous when they are actually...
Absolutely, and there is this lack of understanding of risk somewhere, in a sense that today, frankly, when people look at market returns, nobody says, what is the risk I took when these market returns came? So I think it's very important to understand what are the risk-adjusted returns you make. Now, I'm not getting into the maths of it, but I think intuitively people understand that. But somewhere when you're seeing that carrot in front of you, 20%, 25%, somebody's made 50%, I think everyone falls for that. We have seen that in, say, Bitcoin for late. So it's clearly the same story. So I think it's very important as individuals, we spend time on this issue. I think problem I find is that a lot of friends I also have similar issue. They're very busy professionals. But nobody really wants to spend time on this. Everyone wants that quick fix. Bata kya lena hai. Okay, so I think that is where the challenge is. So determine your risk appetite, determine what your ability to kind of absorb that risk is, determine what your goals are, especially the clear goal clearly has to be make sure you beat inflation, if nothing else. And then move forward from there. So somebody who has a high risk appetite could be 80% equity, 20% debt, depending on his age profile. But there could be people who would want only 30% in equity, rest in debt. Fair enough. Nothing wrong with that. I think it's very individual driven in my view.
Prasun, you've been managing money and investing it for a very long time. I know we can't talk about future projections, but we can certainly talk about the past.
Right.
You said that lots of events happened in the recent past, and even if we go to 2008 when you were still managing, and maybe even before that, after all of this, you've had a US meltdown, you've had conflict in the region, etc., etc., etc. How have the returns been? Have you been able to deliver far better than inflation-adjusted returns?
So let's look at the Indian equity markets. I think despite all the pushes and pulls, despite all that, let's take last 30, 40 years, India has been through everything. We have been through wars, we have been through an emergency situation, we have been through minority governments, we have been through political issues where governments have not lasted more than a year. I think we have seen where we have corporate scandals, stock market scandals. I mean, we have seen everything. Despite that, the equity markets on an average are giving you close to mid-teen returns. So, I think that itself is a lesson in itself, because if over a long period of time, as you said, inflation has averaged between say close to 6.5%, if equity markets are even giving you, forget 15% return, even 12, 13% return, which they have despite everything, I think that's a very, very good return to have. So very clearly the lesson is in a growth economy like India, where your nominal GDP growth at least is close to double digits for the last say 20 years now. In that kind of a scenario, if you believe the market earnings will compound at even say 12, 13%, and in fact earnings have compounded at better than that, even with reasonable multiples, you should be able to get that kind of a return over a long period of time. I'm not saying 25% return, I'm saying 12, 13% return looks reasonable as long as your growth remains in the 10 to 11% vicinity, which I think is a fairly reasonable assumption to make in a country like India, with a real GDP growth of say 7%, inflation of close to 4%, you come to 11%. And with earnings growth of say 12, 13%, because a lot of the parts of the economy are not really represented in the stock market. The weaker parts are not represented. So agri which doesn't grow is not represented in the stock market. So stock markets earnings tend to grow at slightly higher than nominal GDP over a long period of time. Now, you put that together, eventually markets are servants of earnings growth. And if you get that earning growth over the next 10, 12, 13 years, I'm not trying to project here, then logically speaking, barring a real meltdown of multiples, you should be able to make these kind of returns over a long period of time. And that is, I come to my first point, start early. I think you will have these cycles, you will have those phases, you will lose 20%. Those are inevitable in the equity market. This is a volatile asset class.
But the average returns is what you've got to see. And
Absolutely.
what you're saying is we've done 17, 18 odd percent as a country.
Yeah, even if you talk about 13, 14%, I think it's fairly reasonable return, beaten inflation pretty solidly. Pretty solidly.
Okay, let's take some questions. Lots of questions flowing in as well. There is Adele Dilema who has a question. She asks, are ULIPs too costly, Deepak? And I think this is a question which a lot of people have, right? There was a time when the charges were very high. People felt that they had not been told and communicated properly. And I'm talking now 10 years ago. There was mis-selling. People were not aware that there is a lock-in. People felt that this is only a 3-year product and then it became a 5-year product. But lots of regulatory changes have happened. Right? Some of the new age ULIPs that we are seeing today, how cost competitive are they?
I would go to the extent of saying they're probably even more cost competitive than mutual funds. Largely because the charges now are at its lowest possible. I mean, I think HDFC C2I has got just a 1.35 percentage premium allocation charge and no other charge. Of course, there is a mortality which provides a risk cover. A lot of mutual funds have charges over and above this 1.35 number. But the point is, probably people are not aware of this. And, probably the industry as a body, as we were discussing before this, needs to bring about this awareness that there are such products which are available, which are extremely attractive and can help you grow. Because the moment the charges are high, yes, the money which you invest, X amount is deducted. And now you have really attractive ULIPs in the market. So I think and you have quite a few options of them. Prasun, would you like to add to your
very
product?
clearly, I think 2-3 things here. One, ULIPs, by the very nature of the product, requires a disciplined long-term approach. So I think it's very good for long-term financial planning in my view. That is one. And let's look at it as a package what ULIP brings to the table. It brings you complete transparency in terms of where your money is. It brings you complete transparency in terms of what the charges are. So I don't think there's any issue with that. The charges are pretty low, as Deepak said. It brings you reasonably good active fund management. It brings you an insurance cover. It brings you tax breaks. And now with long-term capital gains not being applicable to ULIPs, the way things stand today, I think it even makes it far more attractive than it was prior to the budget. So put all this together, ULIPs are a good package to secure both your protection and investment needs in one go. I'm not saying that you can't kind of debundle it and kind of buy separately. I mean, but the point is, today in today's world, when everyone is trying to figure out how to do things fast and manage in a seamless manner, I think ULIPs with the current charge structure and the current tax regime, I think make an amazing amount of sense for any individual to look at.
And when you say long term, because again, a lot of people confuse the lock-in as the time period. So just because it says 5 years, and we face the same problem even, say with the mutual fund ELSS, where people think it's 3 years and 3 years is when I need to withdraw. So would you say that if you're looking at real long-term wealth building through equity, you should be talking 10 years, 15 years, 20 years?
Absolutely.
5 years is just the minimum. It doesn't
Absolutely.
mean you have to exit after 5 years.
See, you will always have those years like 2008 when the market falls. You will have years like when the 2004 general elections happened, markets fell suddenly. I mean, those events will happen. So therefore, you can never predict those events. You'll always have volatility in the market. But what is important is to look at the long-term returns, and ULIPs kind of put you that discipline. One, you're locked at least for 5 years. So 5 years should be the minimum period you should look at. And then it allows you to go to 10, 15, even 20 years in certain products, and depending on your age, even longer. So to my mind, this is an ideal vehicle where, frankly, because everyone does that mental compartmentalization of money. So this is money which people should say I've parked for long term, 15, 20, 30 years, and after that I will look at it. And as long as the asset allocation is as per your requirement and as per your goals, to my mind, it's an excellent way of doing long-term financial planning.
I think the lock-in plays to your favor in the sense it brings in the fact that you can't move out of this very early. So it, in my opinion, works in favor of the policyholder, because otherwise in 18 months you might decide to just pull out of a mutual fund, in case you find the markets falling. But here, because you're forced to lock in 5 years, good is my opinion. I mean, it might seem forced, but the outcome is actually in your favor.
In fact, there was another question that came in that one of the biggest concerns people have is to protect their children if something were to happen to them. And we are increasingly seeing, as a country, people dying at very, very young ages, right? I think that's a fear that a lot of people have, that what happens to my children if something were to happen to me? And the question that came in was, do child plans therefore work? Is that a solution?
They
that
sure
while
do,
I
because you
continue
can-
to build wealth,
Yeah.
if something were to happen to me, my children will be taken care of?
Yeah, very clearly, because one, this is the insurance safety net, and then you can opt for the waiver of premium. So even if you're not there due to the unfortunate event, the future premiums are taken care of, and therefore your child has the required corpus at the end of the term. So very clearly they can act, they can be perfect for that kind of a requirement.
There was another question, can I do an SIP in a ULIP? SIP has become the buzzword. It's more like a mode. People think it's another mutual fund. It isn't. It's just a method of investing monthly. Can you do that in a ULIP?
You have that option. In fact, I think the majority of the people use the monthly mode to invest in ULIPs rather than going into the bulk annual payment mode. And it works exactly like a SIP, which works in the mutual fund. Invest, maybe 1,000, 5,000, whatever is comfortable to you. Pay out every month, and you
can start with as little as 1,000?
Yeah, absolutely.
In some of the schemes.
Yes, yes.
And these low charges that you talked of, Deepak, is it more if you go online or through the agency force?
Most of them are online plans.
Online
Yes.
products, which is okay because young people are fairly savvy these days. There's another question. Shashi Kumar Vostok has sent. Good morning, sir. Will the LTCG tax implications affect ULIP investments too? I think you partly answered that, but you want to clarify?
As of now, very clearly, because under section 1010D, proceeds of insurance are exempt from tax as long as your sum assured is 10x your premium. So as long as that condition is met, these are. So therefore, the new ruling, which is coming the budget on long-term capital gain tax on equity holdings and mutual fund holdings, is not going to be applicable to ULIPs. So therefore, it makes them even more attractive, as I said.
Prasun, you talked about asset allocation briefly, and I want to touch a little bit more about that because I think that's a concept which very few of us understand, right? For us, investing is let's go buy XYZ product and we're done. And increasingly, I find, even when it comes to mutual funds or any investment, people are tanking themselves up on equity, but not necessarily looking at debt as well. Now, if you go through the route of the mutual fund, it's like you've got to pick up several schemes, right? You have to have, say, a large cap, you have to have a mid cap, you have to have a small cap, because each has its own definition, and that's even getting tighter now by SEBI. And then you've got to pick some debt funds, ultra short term, income, etc., etc.
Right.
Now, when I buy a ULIP, do I have a plethora of these within the same plan that I buy? And how does it work?
So, for example, in HDFC Life Click to Invest, you have, say, 8 funds from which you can choose. So, you have options on, say diversified equity funds, mid-cap equity fund, a balanced kind of a fund, a fixed income fund, all these put together. You can, depending on your asset allocation, you can choose. And the most important part is that you can move between these funds, and there's a certain amount of free switches allowed, whereby if you want to change your asset allocation at times, it's hassle-free. And with no charges up to a certain limit. So I think it's a great thing. So with one product,
I have to choose only one of the funds.
You can choose any change. You can make a basket of all the funds. Depending on your asset allocation you may want, I want 80% equity, 15% long-term debt and 5% short-term debt. Pretty much available.
Okay.
So it's a pretty, and then between that 80% equity, you say I want 60% large cap and only 20% mid cap. That is also available. So you can pick and choose your asset allocation within the same plan, and it's hassle-free effectively. One tick and that's it. And you can change that allocation the way you want. There are no implications.
So you don't have to get out of the scheme.
You don't need to get out of the scheme.
An exit charge, get back in.
There are no exit charges. Beyond a certain number of free switches, there could be some nominal charges, but that is about it. But our experience has been that most people don't even end up using those free switches which are available.
The new age ULIPs that you talked of, where the costs are so low, are they also coming embedded with health, with child plans, those kind of options in them, critical illness, or are they just very simple?
Most of them are right now plain simple vanilla investment plans. They haven't moved into the child domain of child insurance. But it's a matter of time. I think innovation will come in. The riders are the ones which provide the health component. So you will need to buy, or you've got, like a cancer plan which you can buy along with it. But as things stand, the plans which are available, which are very low cost ULIPs, are plain vanilla investment plans.
You've done something, a tie-up with Apollo, for example,
right,
where you have a combined
with a term plan.
Simple investment low-cost product?
No, that's not with an investment plan. That is with a term plan.
Okay. So within the investment basket, for example, if I were to buy a child plan, there
are options available.
Are those also cost competitive, or are those?
They may not be as cheap as the Click to Invest series, but frankly, the costs there are also not very high today. They are marginally higher than the Click to Invest. The asset management charges remain the same, but some of the other charges could be higher. But those plans are clearly available. For example, we have Youngstar, which takes care of that.
Okay, there are some other questions coming in as well. In fact, if you're watching, you want to send some questions, please don't hesitate. We've got some coming in as well. Okay, now here's the killer. There is someone who says that I am 22 years old. I want to start investing. I was till now thinking of mutual fund, but post the budget, I'm also thinking ULIP. So what would your answer be to that?
Clearly, it has to be a mix of different financial products. I would not recommend going all in to the ULIPs itself.
But if you're a person who's just starting, you have say 5,000 rupees to invest, we're not really looking at 10 different products.
Then it's a tough call. With the 5,000 kind of purse, I wouldn't immediately try to recommend a ULIP upfront. But it's not a bad option. I
meant 5,000 a month.
5,000 a month is a good amount. 60,000 in a year is a healthy amount to sort of invest. You can go into mutual funds, you can go into ULIPs. PPF is something I would strongly recommend. Yes, the returns are, I think given that it is a EEE product, I think it should be part of a portfolio of a person who's investing 60,000 in a year. So I would say with 60,000 in a year, spread it out a bit is what I would say.
In fact, Prasun, post this budget, is a ULIP the only investment plan which is EEE now?
Yeah, maybe apart from PPF, I guess, yeah.
Yeah, I meant from a market
From a market perspective, yeah, absolutely. ULIP is the only one which is EEE.
Which is exempt, just to explain that to our viewers, where at every stage your money is exempted. In fact, the other important part is that even, for example, debt, if you buy it otherwise, through a mutual fund, you pay tax when you exit, right?
Absolutely.
But within a ULIP, it is not taxed.
The rules related to insurance will apply. It doesn't really matter which product it is.
Okay. So even if I am investing in debt, which I should,
yeah,
as and when I exit or switch, I don't pay a tax on that.
No. So when you're moving from fund to fund, there's no tax implication within the same fund.
And anyway, you're not exiting.
You're not exiting.
You're within the same fund.
Absolutely.
Right.
Just be careful if it's a ULIP, which is a pension plan.
Okay.
There the taxations are slightly different.
Okay.
It could impact you if you try to surrender it early.
And how does that work, if you can explain?
So in a ULIP, in a pension plan, whether it's a traditional plan or a ULIP, you are sort of forced to stay through the course of the, and on, let's call it maturity, you're forced to invest at least 2/3 of the corpus which you've built into an annuity. You don't have an option. You have to invest 2/3 into an annuity. If you try to move away from this and try to surrender, then the money which you withdraw is taxable. So just since we are discussing ULIPs and taxation, pension plans are something which are an exception to this.
Yeah, but the insurance element is not there, so that's a pure pension play. So when you're talking about ULIPs here from a long-term capital gains perspective, we're talking about the insurance-related plans here.
And also when you buy a ULIP, it's essential that 10 times of whatever premium you're paying is what your cover is.
Right.
So if I'm investing say a lakh or say 10 lakh, I'm getting a 1 crore cover.
Right.
And that's something that continues to run every year. Do I keep paying the same mortality charge or does it keep reducing?
That depends on the way the product is structured. Yeah. So, but yeah, that 10 times cover is there, and that is the important part. So when people look at ULIPs, I think it's very important to look at the tangible and the intangible benefits you get. A lot of people tend to compare only the investment returns vis-a-vis what the premiums they gave, but the fact is you got into it because you also wanted a protection, which hope people don't need to use, and that's the way. But when people don't need to use that, they tend to ignore that as a value which has been accreted to them. So I think that has to be looked at. So it's a package product which gives you everything you want, from protection to investment, and a lot of options within investment and good tax savings at the same time. So I think nothing really beats it at that.
In fact, Aisha Ilavia has a question: are ULIPs tax efficient? Aisha, both Prasun and Deepak answered that question. Yes, they are extremely tax efficient. In fact, they're more tax efficient compared to any other market-linked instrument. Then there is another question: post LTCG, is it better to invest in ULIP rather than MF? I think again, the question, Amit, really is that is it more tax efficient than a mutual fund? Yes, post budget it has become more tax efficient than even an ELSS. Is it on charges? Is it less than a mutual fund? Some of the new schemes that have come in, and if you buy them online, they are less costly than a mutual fund. I think one of the issues, Prasun, the critics that they say is that unlike in a mutual fund where I can, if I'm not happy with the fund management, I can move away. I can switch away from one scheme to another. Of course, you bear the cost of that, but you still have a vote that I'm not happy with the way this fund is being managed. Whereas in a ULIP, I'm stuck with that fund manager for at least that 5-year period. Is that a concern according to you, or do you
in a limited way, yes. But the fact is that since you give people an option of moving across funds, so you're not just managing one fund. Even within equity space, you'll have more than one option. And if one fund is not necessarily performing, it's not that the insurance companies have only one fund manager. There are multiple fund managers within insurance companies as well, and therefore there is always that choice of moving from one fund to the other. And I think that is available. So, and the fact is the way the insurance companies, some of these funds have performed, I think the long-term performance has been pretty good compared to the market, and I think that has stood the test of time over the last 10 years.
Okay.
So in my mind, yes, it is a little bit of a concern, but again, I think it's important and very important here actually to look at in a holistic manner. One, if you start judging a fund performance after 1.5 years, be it mutual fund or a ULIP, I think that is a little bit harsh. So you have to give the fund managers some time. Number two, you have always need to compare against the benchmark. Sometimes comparing against the peers without looking at the risk some of the peers are taking is irrelevant. Because if I am running a large cap fund and you start comparing it with a fund which has 40% exposure to mid caps, and when mid caps are doing well, obviously that fund will do well. But one has to really take cognizance of the fact that that particular fund is taking a much higher amount of risk, and therefore the returns are not necessarily comparable. Unfortunately, that does not happen. I think so that comparison has to be made in the right way and over a right time frame. See, there will be every fund manager will have those 12-18 months of underperformance vis-a-vis peers or against the benchmark. You take the long-term track record of the fund as well as the fund manager into account before you take that call, and that applies, as I said, not just to ULIPs but also to mutual funds.
And would you say that by and large in the last 15-20 years since ULIPs came into existence in India, the fund performance has been pretty much at par industry to industry with the mutual fund industry?
Very difficult for me to say. I don't think I have done that comparison, but broadly speaking, against the benchmark, most of the insurance funds have done reasonably well. So my sense is if they have done reasonably well against the benchmark, they would have done pretty okay compared to the peer group within the mutual fund space. Having said that, yes, the insurance funds tend to take a longer term view. They have probably lesser risk inbuilt into them because the exposure to say mid caps has been lower than some of the mutual funds. So again, if one has to compare strictly returns, one has to put the risk back into the equation. But as long as I'm beating the benchmark over a longer period of time, I think then the insurance companies are clearly adding value to the investor. Because you're not just beating inflation, you're also beating the underlying market benchmark over a 5, 10, 15-year period. I think that is a great return to have.
Okay. Clearly, if you are measuring fund managers, then this product is not for you. You might as well go into directly into equities, because I don't see any retail investor having a measurement performance of fund managers. That is, way too extreme an investor and way too involved, and a guy who tracks the market at a much, much different level. So that is a different play altogether. I don't think that is a retail investor.
It's very easy to get confused with that. There's so much of data.
So many factors.
You can pick and choose your time frame to prove some fund manager has done well, and you can change the time frame to prove the same fund manager has not done well. So, I mean, one has to be very scientific about it and very consistent about it. So
I
don't think the retail investor
was that have they been equally good, because again, even within say a mutual fund, you'll find a wide variance between one scheme versus the other in the short term.
Let me put it this way.
But broadly, would you say that the kind of returns that investors have got is the way it has been, say, with the mutual fund industry, where again some schemes have done well and some haven't done
let me
well.
put it this way. See, if I take, say, the entire gamut of mutual funds in a comparable manner, put that in a table, would ULIPs be median or better than the median? I think yes, purely because more than 50% of the funds tend to underperform the benchmark over a period of time. And if your fund has outperformed the benchmark over a 10-year period, that is clearly better than the median. So I think that is the way to look at it, because there will always be phases one fund does better in a particular time frame, other fund does worse. So I don't think that is the right way to look at it. Clearly think long term, try and see if your fund is kind of beating the benchmark over a longer period of time. How consistent is the performance, what is the risk in the fund. I think those are the ways to measure a fund. But as he said, I don't think the retail investor either has the time, inclination or the understanding to get into those kind of details. So you clearly need to look at equity as an asset class which can deliver you good returns, inflation beating returns over a longer period of time, and that is it. I think that is where it has to be.
Okay, here's another question coming. A lot of insurers are giving loyalty additions in ULIPs. Is it a gimmick or a real benefit? Are you aware of this?
Well, it's not a gimmick. It's an absolute new variation which has come into the market, I would say, in the last 3 odd months.
Okay.
Basically, the insurance companies are playing on how well the fund performs.
Okay.
And if the fund is performing really, really well, so from that they pass on a bit of benefits as loyalty additions to the customer. So
Okay.
I think
what kind of loyalty additions?
so. I think they add units to
they add
extra
units.
units to the for funds which they already own. Time will tell how it is going to play out. Risky. In the sense, I wouldn't say risky, I would say aggressive. But yes, it's an option which is there, and more options for the customer, the better it is.
No, I think it's a way to kind of incentivize the customer to stay the longer term.
Yeah, that's true.
Okay.
So the way you look at it, loyalty additions will typically be, say, at the 10th year of the. So idea is to kind of incentivize the customer to say that, okay, if you stay longer, we'll give you something more.
Okay.
I think it's a win-win situation for the customer and the insurance company, because we'd want the customers to stay as long as possible, and therefore if by giving a certain amount of incentive that helps the customer, I think loyalty additions work on that count.
So it's not a gimmick.
It's not a gimmick in that
It's
sense.
happening. Okay. There's a question for you, Prasun. How often do you revisit the stocks you are invested in ULIP funds in HDFC Life?
So, okay, let me put it that way. So, there's always, I'll make a distinction between reviewing the portfolio and making changes in the portfolio. We review the portfolio virtually every day. There's nothing, I mean, every day the market moves up and down. You look at what your stocks have done and you decide, you challenge your assumptions saying what is happening. So, most often you realize that short-term movements are just sheer noise and you want to ignore it. So, the way we look at it is that, is there any fundamental change which has happened in the stock, which forces me to change my assumptions about this stock? For example, if I think that this stock is going to kind of grow the sales at 15%, margins are going to improve by 50 basis points, and therefore the bottom line is going to improve, say, by 17-18% over the next 12 to 18 months. So quarterly results come out, that assumption gets challenged in a meaningful manner. Either the company surprises on the positive side or surprises on the negative side. Now then you say, okay, fine, my assumptions have got challenged. Now what do I do? So then the call to be made is whether this is a one-time discrepancy the company has. You talk to the company, you look at the numbers in detail, you talk to other market sources, then you take a call. Is there anything dramatic happened in the company so that its long-term projections have changed? Or is it just a one-off quarter where every company can go through? So based on that, you take your call. So if I were to put things in context, how often do we churn our portfolio? We are very low churners of our portfolio. So the strategic allocation over a period of time has been consistent. So what we are saying is, what is that will suit our portfolio from not even 12, maybe 24 to 36 months kind of a story. Which sectors, which kind of stocks, and then unless our assumptions get seriously challenged, if a stock, for example, I believe is going to give me 20% return and suddenly the stocks move up by 20-30%, I will book profits because that is purely because of some random event the stock has moved up, I will book profits. Or the other way around where, for example, you're holding a stock and certain regulatory changes happen which kind of make sure that the next 4-5 year numbers now look very difficult to predict. You will exit. But barring those extreme events, you tend to stick on. Idea here is that when you choose the stock, you take a longer term call. You choose good companies with good governance and stick to them and try and ignore the noise unless it changes your fundamental assumptions. That's the broad rule. Our churn is pretty low.
Are there any regulatory guidelines within which you have to?
Yes, there are regulatory guidelines like everything else. We have our internal risk limits also which we follow. So for example, you'll have certain risk limits in terms of how much allocation you make to a single stock, or how much overweight, underweight you want to be a particular sector. I think those are like every fund manager would have that discipline, and those are stuck to religiously. For example, if I'm holding a particular sector, I don't want to be more than say 15% in that sector, and this sector does very well, I will sell because it's now going beyond 15%. If it does badly for a while, and if my longer term assumptions haven't changed, I'll add to that sector. So I think that applies also to an individual's asset allocation, in my view. Because let me try and link it back to an individual's asset allocation. Most of us do our asset allocation saying, okay, fine, we all have thumb rules. Okay, my age is so and so, therefore this is my equity and this is my debt. Frankly, those rules, in my view, don't make much sense. So what one has to do is to go back to the basics, probably work with a financial planner, go through the rigor of what you want, and then do asset allocation, and then review that every 6-12 months. Nothing before that. And see, you wanted to start with 60-40. After 12 months, you realize you are now 65-35. What do you do?
So what should you do?
Ideally, you should kind of bring it back to 60-40.
Because the temptation happens.
Temptation
right?
is, let me
has
stick
gone up.
So I think
that
is the kind of rigor we try to follow with our portfolios as well, where we say unless your fundamental assumptions are challenged meaningfully, you tend to stick on with the companies you have. You give them time to perform. See, nothing performs in 3 months. And yeah, you will make small tinkerings here and there, but broad portfolio. If you look at our portfolio for the last 2 to 3 years, number of stocks which we haven't really done any changes in is pretty large. So I think that is the whole idea about long-term investing. Choose the right things, choose the right asset allocation, and stick to it, and let the compounding work its magic.
How easy is it to buy an insurance plan online?
I would say it will take you anywhere between 15 to 30 minutes to go through the entire process. Probably a lot of technology will come in and will make it a shorter time period. With eKYC solving a lot of problems, with income documents being grabbed automatically by the insurance company. So there's a lot of work I think happening in the back end, which is going to make the processing part really quick. There is tele underwriting happening. Medical tests are also being done on the phone, in the sense they're asking a lot of questions on the phone and then trying to understand.
Medical tests for a ULIP as well?
Yes, in some cases, yes. So it depends on the amount of investment that is there. So I think it will probably come down to 15 minutes, but anything less than that, I would say is difficult to achieve.
Thank you, gentlemen, both of you.
Thanks,
and it's been a lovely conversation. Thank you. Wish you all the very best. Well, that was this very fascinating session with Prasun Gajri and Deepak Yohannan. We'll, of course, keep bringing you many such conversations. The idea is to decode insurance. Let's try and understand it. There's been a lot of changes in the sector. Lots of regulatory changes, in fact, and it's important that we don't lose sight of the larger goal, which is that we have to invest. There's no option. It's not a choice. You have to do it. Thank you very much, and look forward to many more such conversations with you.